to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Chris Dearborn. He's the managing director on Nasdaq's market intelligence desk, and we are here for our favorite hit of the week. It's our last hit to wrap up what's been a volatile week. Chris, you know what? It's kind of a welcome sign to have volatility back in this market, particularly if you're a trader. You actually have stocks to trade, sectors to trade. Might be a little bit nutty if you're a portfolio manager trying to manage your overnight and longer term positions, but it's been a welcome sign to see some trading back in the market.
Absolutely. It's good to see the vol back in.
Yeah.
Definitely it's good to see movement within the equities. And odds are if you're probably a long-only trader or a long-only PM, you're on vacation. And this is a good week to take off for a vacation. I mean, the markets this morning, volatility is definitely back. You saw a significant rally yesterday into the close, which kind of started on Wednesday morning when the markets opened at the lows. Yesterday closing up, north of 2%, even higher for some of the different sectors. This morning we were off significantly. We've rallied back pretty nicely though. So what you're looking at here is that volatility in the market where both day traders, macro traders, and also some long onlys can get some very nice entry points to capture a little bit of spread.
You know what's interesting? I took a look at the exchanges before I came in here. So CME, ICE, SIBO, Nasdaq, of course, all trading at highs of the day. And that makes sense because the volumes are up with this volatility.
Correct. So that's a little insight into our business.
Yep.
Absolutely. Volume is good for our exchange.
All right, let's take a look at this sector map, if you will.
Yep.
Our first chart of the day. And, for obvious reasons, only one of them is in the green.
Yep, this is something a little bit earlier today. This is captured around 11 o'clock when we put up the morning note. It's something we look at every day. It's an Excel spreadsheet that we pulled directly from Bloomberg. And we're just mapping the 11 largest sectors of the S&P, the major sectors. So it's going to ignore the colors a little bit, but they kind of go. Utilities in this morning was the only sector in the green, which makes sense because it's a safety haven play. And then technology, industrials, consumer discretionary, all down over 1%. Basic materials got even worse. It got worse earlier. But now we've run bound. Some of that makes sense in the back of the president's comments on Huawei this morning, saying that you may not be able to do business with them. And there's some other comments that he made back and forth in there that kind of move those sectors because there's uncertainty again in that U.S.-China trade talk. That's going to be a continuing theme that we're going to be talking about for months and months and months, and we have been talking about for months. So again, until that gets cleaned up, the volatility based off of that is going to keep going. And what you're looking at here is the sectors reacting to that. All of them down this morning, all of them down big. But then again, not giving back as much of the rally that we saw yesterday, only giving about anywhere from half to a third of that rally. And right now the markets, the Dow was flirting with going positive only about 15 minutes ago. The Nasdaq was down over 1.5%. We're down about 0.5% now, give or take. And you got some nice stocks that are turning green here. Starbucks is up today. Comcast is up today. You've got still the tail end of earnings coming through, and then the retail numbers come out next week. Retail earnings start to hit next week at Macy's and a few others. So there's still a lot of news here that could be significant to the markets, but none of it matters because there's only one thing that matters, and that's China-U.S. trade talks and everything that goes around it, including currency devaluations, the impact on the 10-year, the impact on German Bund. Europe's still a mess, but that's kind of getting ignored. Brexit, Germany, Italy government last night. But that's all getting ignored. What's moving the markets now is the president's comments, tech, industrial, consumer, basic materials, all down.
Right, and we saw that happen all week. Anytime it was a good day for the trade talks, we had technology at the top of the map, and consumer discretionary, of course, because their margins are thin within the consumer space. These tariffs will impact that. So it makes sense to see where they are right now. But again, that lends to some interesting trading activity. It's kind of interesting to have that narrative versus the only macro moving the markets.
Yep.
Let's move on to our next chart. You brought this up before. This is the S&P versus the 10-year. And of course, yields, global yields, really has been the other story this week.
It really has. So I pulled this chart out today. It's a 3-year look. And for those who follow and know, the S&P stocks and bonds are inverse. So the 10-year yield in the 10-year should move lock, stock, and barrel with markets. When people are buying stocks or selling bonds, therefore, the yield on the bond should increase. And when people are buying bonds, the yields decrease, and therefore it should be pushed down. So if you look starting here in September 2016, you've had certain spikes back and forth. Those are just blips on the market, but you can see they're moving lock, stock, and barrel across the board. And really, the diversion happened back in March when you had the trade talks kind of hit the fan. And with that, you see there's been an appetite for bonds. There's also been an appetite for safety plays such as gold, and absolutely an appetite for equities. Go figure, we made an all-time high in the S&P only a couple of weeks ago. And you can see towards the tail here, is that dichotomy going to continue, or are we going to get back into sync? with yields today at 1.7% on the 10-year U.S., and S&P really volatile in the market. It's really hard to say, but this is not normal, and it shouldn't be happening.
That is, I mean, look at the divergence.
That's why we pointed out it is not normal. And what you're seeing is flows into everything. People are afraid of equities because there's an uncertainty, but you have an inversion risk here, which could have a broader reaching fear factor to the U.S. as well as broader GDP. And that inflation item just keeps coming up. If this keeps happening, that's going to get revisited over and over again. So what's going to happen here? Is there going to be clarity on the U.S.-China trade talk? There's no way there's going to be. That's going to play out to the political election. If something happens good in September, that's great, and you'll see the markets run. But they'll only run to the next tweet, or they'll only run to the next target.
I mean, they're talking about kicking that down the road right now, today.
Right. So there's no thought pattern to it. It's whatever is moving the market. The market's reacting. The volumes are great. We saw another 8 billion share day yesterday in the consolidated tape. We've had 8 or 9 billion shares every day this week. Today, volumes are high as well. We're over almost 5 billion shares already on the consolidated tape. We could top 8 again. Remember, the average is only 7.2 billion. Pardon me. Volume does validate that move. That's telling you that traders are here. They're in the market. And if you're uncertain about it, look at the VIX. VIX had a 19 handle today and a 14 handle earlier. It's nice action.
All right, Chris, thank you so much. As always, we'll talk to you next week. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.